Your car insurance went up again this year, and you've never filed a single claim. That's not a coincidence. That's the pricing model working exactly as designed. By the end of this, you'll understand the 5 mechanisms insurance companies use to raise your premium regardless of what you do behind the wheel, and why most of the variables they're using to price you have nothing to do with how you drive. The first thing to understand about car insurance pricing is that your personal driving record is only one input, and in most cases, it's not even the dominant one. The industry calls the underlying method actuarial risk pooling. What that means in practice is this. Insurers group you with thousands of other people who share certain characteristics, and your premium reflects the aggregate loss experience of that group, not just your own behavior. This is the foundational mechanism, and most people never learn it exists. When you pay your premium, you are not paying for the risk that you will crash. You are paying for the statistical likelihood that someone in your category will crash, and the insurer is betting that your premium, combined with everyone else in the pool, will cover the payouts when they do. The category is built from dozens of variables: your age bracket, your zip code, the make and model of your vehicle, your marital status, how many miles you drive per year, and several more. Your individual claims history sits inside that category. It doesn't replace it. I pulled the numbers on this to make it concrete. According to data from the Insurance Information Institute, average U.S. full coverage premiums increased by approximately 26% in 2023 alone. That's the single largest one-year jump in modern recorded history. The national average annual premium for full coverage now sits at roughly $2,500. That's over $200 a month, before you've done anything wrong. Here's what the pool mechanism looks like when you put 2 real profiles side by side. A driver with a spotless 10-year record in a high-claim zip code will pay more than a driver with 2 minor at-fault accidents in a low-claim region. I ran both profiles through the actuarial logic, and the result is not close. The pool overrides the individual, consistently and by design. The insurer's incentive is not to price you fairly as a person. The insurer's incentive is to price the pool accurately as a product, to ensure the premium revenue exceeds the claims payout for that category. Those are not the same thing, and conflating them is exactly what makes renewal letters feel arbitrary. They're not arbitrary. They're just measuring something entirely different from what you think they're measuring. Here is the variable that stops most people when they see it for the first time. In the majority of U.S. states, your car insurance premium is directly influenced by something called a credit-based insurance score. This is not your FICO score. It is a separate score built by insurance companies using similar raw inputs: payment history, outstanding debt, length of credit history, new credit inquiries, and then converted into a proprietary risk rating that directly affects what you pay for auto coverage. The logic the industry uses is this. Research shows that people with lower credit scores file more insurance claims on average. Whether that correlation reflects financial stress, lifestyle factors, or simply the demographics of who tends to have lower credit, the insurers don't especially care. The correlation is there in the data, so they price on it, and they are legally permitted to do so in 46 U.S. states. California, Hawaii, Massachusetts, and Michigan are the only 4 that prohibit the practice. The mechanism is precise and largely invisible. A missed credit card payment in January can lower your credit-based insurance score. That lowered score gets factored into your auto insurance renewal in March. You receive a letter that says your premium has increased. The letter does not say why. It does not mention the credit score. It says something like rate adjustment based on current market conditions, which is technically not false, but omits the variable that actually moved. When I mapped out what this spread looks like in dollar terms, the numbers are uncomfortable to look at. Drivers with excellent credit pay, on average, 40 to 50% less for auto insurance than drivers with poor credit, for the exact same vehicle, in the exact same location, with the exact same driving record. In some states, that gap is even wider. The Consumer Federation of America found in one study that the credit score penalty can add over $1,000 per year to a premium, purely from credit variables, not claims history. What makes this particularly effective as a pricing tool is that most policyholders have no idea it's happening. The insurance company collects your credit data when you first get a quote, and then rechecks it at every renewal, often without explicit notification. Your premium is being updated by a financial variable that you associate with loan applications and credit cards, not with driving. The disconnection is intentional. A mechanism that people understand is a mechanism people can respond to. A mechanism they can't see is one they can't fight. This is the mechanism that the industry actively avoids discussing because it operates in direct contradiction to the customer relationship the insurer is trying to project. It's called price optimization, and the way it works is worth spending time on because it's precise. Insurance companies, and the third-party analytics firms they hire, build predictive models that estimate the probability that any given customer will shop around and switch at renewal. The inputs include how long you've been with the company, your age, your payment history, whether you've called to ask about pricing, whether you've ever requested a quote elsewhere, and a range of other behavioral signals. Customers who are assessed as unlikely to switch, low price elasticity in the actuarial language, are systematically charged more at renewal. Not because their risk went up, because the model determined they won't leave. The Consumer Federation of America brought this practice into public view in 2015 with a formal complaint to state insurance regulators. They found that major insurers were using price optimization models to raise premiums on loyal, long-standing customers, specifically customers with clean records and no claims, while offering more competitive rates to new customers or to customers the model flagged as likely to switch. The insurers were, in effect, charging a loyalty tax rather than a loyalty reward. Here's what that looks like in practice. A driver with 8 years at the same insurer, no claims, no moving violations, living in a stable zip code. That driver is a near-perfect policyholder from a loss perspective. They are also, according to the pricing model, almost certainly not going to leave. So the insurer raises the renewal by 8%, then by 6% the following year, then by 9%. None of those increases are driven by claims. All of them are driven by the model's assessment of how much it can extract before that customer finally calls a competitor. I ran both trajectories across an 8-year window using a $2,000 base premium, and the cumulative difference is significant. The loyal customer, receiving average annual increases of 7 to 9%, ends up paying between $4,500 and $6,000 more over that period than a driver who gets a fresh quote every 1 to 2 years. The product is identical. The risk is identical. The only variable is the insurer's confidence that the customer is captured. Some states are beginning to restrict price optimization explicitly. California banned it in 2017. But in most markets, it remains a standard practice. The insurer's incentive is not to retain your business by offering you fair pricing. The incentive is to extract the maximum premium your behavior suggests you'll tolerate. Every insurance premium you pay contains a line item you never see on the invoice, a forward projection of future costs, built into the price using something actuaries call a trend factor. Understanding this mechanism explains why premiums can rise aggressively even when you're in a claim-free year, and even when the overall accident rate in your area hasn't moved. The way trend factors work is this. Insurers know that when a claim is filed today, the actual cost of settling that claim, medical treatment, vehicle repair, legal fees, disability costs, will be paid out months or sometimes years from now. The premium collected today needs to cover that future cost, not the cost as it exists today. So insurers apply a forward inflation rate to their projected claim costs, and that inflated projection gets baked into your current premium. You pay tomorrow's repair bill today. I ran this out specifically for the sensor and camera systems now built into modern vehicles, and the numbers moved sharply. The average cost to repair a new vehicle with advanced driver assistance systems, the cameras, sensors, and radar units now embedded in bumpers, mirrors, and windshields, increased by approximately 30 to 40% between 2019 and 2024. A minor rear-end collision that once involved a bumper replacement now involves recalibrating or replacing a suite of sensor equipment. When I map that cost increase against the trend factor formula, the result is that your current premium is already absorbing repair costs that haven't happened yet, for a vehicle that may never be involved in an accident. The repair cost is structurally higher, and that higher cost gets trend factored into premiums across the entire vehicle class, including your vehicle, whether or not it has ever been touched. Medical cost inflation compounds this further. The average bodily injury liability claim in the U.S. has risen at rates well above general CPI for over a decade. Insurers track these trends quarterly, model where they'll be 18 months from now, and price that estimate into your next renewal. There is also a legal component driving this that rarely makes it into public conversation. Social inflation, the documented tendency of juries in personal injury cases to award increasingly large verdicts, has changed the insurer's liability calculus in certain U.S. markets. States with a history of large jury awards are now being priced into a different risk tier by many insurers, and that tier repricing flows through to every policyholder in those markets, regardless of individual claims history. Litigation risk is now a geographic pricing variable, the same way weather risk is. You don't have to be involved in a lawsuit for a lawsuit culture to raise your premium. The trend factor mechanism means that even a sustained period of careful, responsible driving cannot fully counteract rising baseline costs. You're not paying for what you've done. You're paying for what the models project your category will cost to service in the future. That's a structurally different contract from the one most policyholders believe they've signed. There is an entire insurance market operating one level above the policies you hold, and it has a direct, measurable impact on your renewal price every single year. It's called reinsurance, and it's the mechanism by which your insurer buys insurance against its own losses. When that market moves, every policyholder downstream moves with it, whether they know it or not. Here is how the structure works. Your insurer collects premiums from millions of policyholders and assumes the risk of paying claims, but no single insurer wants to hold unlimited exposure. If there's a major hurricane, a widespread weather event, a spike in claims across an entire region, the concentrated losses could exceed what a single company can absorb. So insurers buy reinsurance contracts from specialist reinsurers, companies like Munich Re, Swiss Re, and Hanover Re, that agree to absorb losses above a certain threshold in exchange for a share of the original premium income. When reinsurance costs rise, the insurer's cost base rises, and the insurer's cost base is what your premium is built on. In 2022 and 2023, reinsurance rates for U.S. property and casualty coverage increased at some of the fastest rates in decades, driven by the cumulative impact of several years of elevated catastrophe losses, rising claim severity, and reinsurers repricing their own climate exposure. According to data from global reinsurance broker Gallagher Re, global reinsurance pricing increased by roughly 37% across 2022 to 2023. Those increases fed directly into the renewal pricing of the primary insurers that had purchased that coverage, and then, by extension, into the consumer premiums those insurers set. The reason this mechanism is invisible to most policyholders is that the reinsurance transaction happens entirely outside their view. You have no relationship with the reinsurer. You've never signed a contract with them. You have no leverage with them, no ability to shop their rates, and no access to information about what your insurer is paying them. Yet, when global reinsurance capacity tightens, because of climate event accumulation or because capital is flowing elsewhere, the effect lands on your renewal notice as a line that simply says, adjusted rate. Climate exposure is now being priced into reinsurance contracts in a way that wasn't true 10 years ago. Reinsurers are modeling long-term climate trajectories and demanding higher premiums from primary insurers in regions that their models flag as elevated risk, not just for homes and property, but for auto coverage in those same regions, since hail events, flooding, and severe weather also total cars. The pricing of risk that may materialize over a 20-year climate window is being loaded into the premium you pay this year. There is no opt-out mechanism for this. It is structural. When you put all 5 mechanisms together, what you're looking at is a system that was never actually designed to price you as an individual. It prices categories. It uses financial data you associate with credit cards, not cars. It charges a loyalty tax, penalizing the very behavior the marketing suggests it wants. It loads projected future costs into your current bill before those costs have materialized, and it passes through an entire secondary market of reinsurance costs that you have no visibility into and no ability to influence. The framework that comes out of understanding this is straightforward. Your premium is being driven by at least 5 variables that have nothing to do with how carefully you drive. Risk pool contamination, credit-based scoring, price optimization against your perceived inertia, trend-factored future cost loading, and reinsurance market movements. The one variable you can actually influence, your personal claims history, is the one the system gives the least independent weight to. What this tells you is where the leverage actually exists. The drivers who pay the least are not necessarily the safest drivers. They're the drivers who understand the pricing inputs, who actively create competition for their business at every renewal cycle, who manage the non-driving variables that feed into their score, and who treat the annual renewal not as an administrative task, but as a negotiation with a counterparty whose interests are structurally different from theirs. The mechanism is not neutral. Understanding it is the first step to engaging with it on accurate terms.